and thank you so much for joining us today. On behalf of my colleagues here at Kroll and our wonderful partners from the StepStone Group, welcome to the latest webinar to highlight our Kroll StepStone private credit benchmarks. My name is David Blowers, and I am the President of Strategy at Kroll. We at Kroll are a global financial and risk advisory firm and the authority at the intersection of valuation, risk, and transactions. Clients come to us when decisions are complex, contested, or have material capital at risk. So it should come as no surprise that it would be a strategic priority for us at Kroll to bring transparency to the activity and data points within the opaque and illiquid private credit industry. We want all of you to look through our lens for research, analysis, performance review, and ultimately to support your investment decisions. And of course, that strategy turned to a reality when we released the Kroll StepStone private credit benchmarks just 5 months ago. And boy, has it been a pretty exciting ride since. We've had incredible interest, support, input from industry participants all around the world. And that interest is because these benchmarks are based on an integrated data set that only the unique combination of Kroll valuation data and StepStone investment data can provide. It's a true case of two heads are better than one. And together, we not only have the most timely database of its kind, but it's also the largest and one that will continue to grow. And finally, it's a dynamic tool that we're proud to deliver in an interactive software format to make your analysis and data integration as easy as possible. To date, we have activated over 250 firms, over 1,200 users, and importantly, this user base has been giving us an enormous amount of valuable feedback on the product itself and potential extensions. And therein lies the reason we are meeting today. Our teams will highlight a substantial and exciting upgrade to the benchmarks that incorporates all of this recent feedback. Those familiar with our initial release will see improved access to data, more data history, new visibility into how the benchmark has been created, audit support, and of course, and always more valuable data points. And for those brand new to the Kroll StepStone private credit benchmarks, you're getting on board at an exciting time, so welcome. Thank you all again for joining us, and now I will cede the floor over to much more capable hands. First to Jovan Samarcic, a managing director at StepStone in the portfolio management team. Jovan has been an outstanding partner to us here at Kroll, and he will both introduce StepStone and then transition us into the latest product demonstration. Thanks again, and over to you, Jovan.
Thank you, David, and hello to everyone. So we will start the presentation by providing some overview of the data set, and maybe just before that also to just give an indication on what the StepStone activities are. So as David mentioned, the database has been built by having the loans from the Kroll valuation business. So Kroll values many loans on quarterly basis. On the StepStone side, we invest ongoingly into many loans, and just combining these two then provided us the capability to build something that we believe is extremely powerful and cannot be matched easily in the market. So just the database that we have at the moment contains more than 14,000 obligors, more than 16,000 deals, and more than 25,000 single loan tranches. A few things that we believe differentiate what we can provide relative to the others is the global coverage. So typically, it's very difficult to find very reliable information on both US and Europe, and we here are able to provide information on both the US and European loans. And very importantly, just the information within the private credit market typically is not available very timely. And here we are effectively updating the whole database and giving access then to the users on a weekly basis. So one is able to very timely have access to the most recent trends that are characterizing the private credit markets. Over time, just we have been receiving several questions with respect to what the benchmarks are, and also very importantly, what the benchmarks are not. So maybe just to clarify before we move into more details. So the benchmarks represent the aggregations of different deal level characteristics. So we are here providing insights into the pricing terms, into the credit metrics, into the riskiness and fundamental performance of the underlying loans. And very importantly, there are on top of that further metrics such as the use of proceeds, if the deals are sponsored, non-sponsored, regional breakdowns, etc. So you will see in more details, of course, how all of this looks like. And then very importantly, to indicate what the benchmarks are not. So we are not here talking about the performance indices. Very importantly, the benchmarks are not based on the BDC filings. So it's really the proprietary data of Kroll and StepStone. And very importantly, because we were receiving many questions with respect to data confidentiality. And so the benchmarks are not providing any information with respect to the single deals. And very importantly, the benchmarks are not disclosing any information with respect to single GPs. So just single deal level information is not and will not be disclosed. And also we don't have any intention of making any kind of league tables or any kind of GP comparisons. So it's really about the private credit market and trying to characterize the market itself. When it comes to the components of the benchmark, so you will see then once we now move into the demo that there are two main parts. So we have the part which is addressing the deals that are being newly originated in the market. So what are the characteristics of these deals, where the pricing terms are, what are the underwritten fundamentals. We do have then the second part, which is addressing the deals that are currently outstanding in the market as of the given date. And there we can provide insights into the fundamental performance. So how are, for example, leverages, interest coverage is changing. We also introduce certain risk metrics that we will talk about. And then what we are introducing now, so that's a new feature, will be the monthly market report. So this will be a relatively brief report with some of the main outputs from our database that we will make available to everyone on monthly basis. And we would hope this will provide further insights into the private credit markets. For the ones that have already been using the benchmarks, maybe just to indicate what will be some new features that you will see. For the ones that are new, I guess everything that will be shown will be new. So when it comes to the new features, we have improved user interface. So one introduced the ability to very easily compare metrics across different market segments. We have introduced longer history, so one can look back for more than 10 years. And also it's now very easy to navigate and to export the data into Excel. Importantly, we have also expanded some of the features so that one can now characterize the market in more detail across sectors, sizes, liens, regions, use of proceeds, sponsored, non-sponsored. So again, just looking how different metrics and volumes look across different market segments, and also providing a very useful market map, which is a comprehensive report on all the benchmarks analytics. So we'll also touch upon that. And very importantly, because we received many questions with respect to moving more also into certain risk analytics and how we can characterize the risk in the market. So for this reason, we have introduced some measures that can be calculated on a consistent basis. And those are the percentage of loans which are valued below 90, and the percentage of loans with interest coverage below 1, and percentage of loans with negative EBITDA. With that, I will now share the platform itself, and we'll walk you through some of the main features. And you should be able now to see the screen. And we will start maybe first with just indicating that so far one was having these new issues monitor. So again, that's characterizing the loans that are being newly originated in the market, and the outstanding issues monitor on the outstanding loans. So now just for the coming weeks until one completely transfers to the benchmarks 2.0, you will have access to the old one, but there is also now very clearly indicated that there are these new sections. So we will now talk just about the new sections. And when it comes to the structure, so if one is looking at the new issues monitor, this has not changed materially. So we have the benchmarks, and these represent different market segments. So one can then check how, for example, the global credit market looks like, or the US first lien, or the first lien consumer discretionary, financials, healthcare, industrial. So one can have then the sector breakdown. One can then have the size breakdown. So again, just to indicate how the upper, mid, lower mid market look like, or large corporates. One can also have different liens, so just how the first lien versus non-first lien look like. And then this is all available also on the European side. And then it's also all available on the global side, which combines US and Europe and adds certain other regions where the data is available. In addition to this, there is a variety of indicators that are available to be seen for each of the selected benchmarks. So anything, of course, from just characterizing the sample with respect to deal count, par amounts, but very importantly with respect to the pricing terms, so knowing what's the typical origination price, the yields, the spreads, what are the typical contractual price in terms, and then also what are some of the credit metrics, so leverage, interest coverage, EBITDA margin, etc. For all of these, one can pick the date as of which it should be visible, and then also there are look-back periods. So one can select either 60, 90, 180 days or 365 days, and this would then give an indication that the loans being shown have been originated effectively in the last 365 days. There are some additional filtering options, but we will indicate that afterwards. And just when it comes to the two main outputs that you can see, one is really the snapshot of how the selected market segment looks like. So in this instance, it's really the global private credit market. And you can see that in the last 365 days, we have the information on more than 800 deals, representing more than 360 billion in origination, and one can then see the typical price in terms, so just the typical origination price of 99, the yield of 9.7%, and then one can also check the spread to 3 years, contractual spreads, and as well as the credit metrics, so typical leverage ratios, interest coverage, and EBITDA margins. Now, very importantly, also the chart is available where one can then see the longer history for the selected indicator. So in this instance, one can see, for example, how spreads at origination have been evolving over the last 10 years. And if one wants to see the shorter history, one can then easily zoom in and then check just into some of the more recent trends. So let's say here, checking how since 2020 spreads have evolved. And not surprisingly, one can see just the broadly accepted fact that the spreads have been compressing over the last year or two. Very importantly, if one wants to compare now spread, let's say, across different market segments, so that can be easily done. So if one wants to, for example, see how the US spreads compare to the European spreads, one can easily then pick the two segments and then again check how the spreads were evolving across US and across Europe. And what can be seen is that the spread compression was more visible on the US side relative to the European side. So both experience the same trend, but in different magnitude. If one wants to, for example, then check also how different metrics such as the interest coverage looks like, again, one can easily apply that and then get an indication on the interest coverage ratio. And not surprisingly, one can again see the trend that when the interest rates were going up, the interest coverage were going down, and they have now recovered over the previous quarters, again, due to the changes in the interest rate, i.e. due to the cuts by the central banks. If one wants to then see in more details, for example, how the spreads and yields have evolved just within the given market segment, so one can then easily pick, for example, the yields and the spreads and then one can see the trend here. So again, once the interest rates started to go up, one can clearly see the trend in the yield, which was going up, and then the spreads were compressing. Again, one of the reasons for that was that the first lien yields became quite high, so reaching 12%, which then led to spread compression, which then in combination with lowering of the interest rate has now pushed the yields further down, but still being at an attractive level when compared to some of the historical context. So again, just the ability to see how the pricing terms are evolving over time. If one wants to see then maybe a similar thing, but just over the upper, mid, and lower mid-market, again, readily available. And one can then see, again, the summary on these market segments. And one can, again, see, for example, the spreads and how they were evolving. And again, by zooming in, one can see different patterns across different market segments. So again, typically having the upper mid-market as the lowest yielding market segment, but then having the mid and lower mid-market just compressing in a similar fashion. So again, one can see that certain spread premia exist for mid and lower mid-market versus the upper. One can see that all three segments experienced spread compression. Now, importantly, if one wants to then check some further filtering capabilities, and for this, maybe European market can be quite representative. So one can, for example, check how the spreads in European market were evolving, but very importantly, one can then also filter for more granular view. So if one wants to see, instead of the whole European market, just how, for example, the spreads in UK have evolved, so one can then just pick the desired country and then have the ability to see how spreads only in UK have evolved. Very importantly, as already mentioned, so all of this can be easily exported, and you will then have the underlying data so that you can then use all the data points that are behind both the table and the chart and perform the analysis. Now, the new feature that has been introduced is the market structure. And here, the goal is to provide an indication, and let's maybe, again, just pick the US credit. So to provide an indication on how, say, the different market segments look. Sorry, give me just a second. So how different market segments look across different views. And here, effectively, one can see then what are the different spreads across different sectors. So for consumer staples, for consumer discretionary, etc. One can see what are the typical spreads for lower mid-market, mid-market, upper mid-market, large corporate. So again, not surprisingly, seeing that the premium exists for lower mid-market versus the other sectors. One can then also check, for example, how different spreads have been for different use of proceeds. Not surprisingly, for the restructurings, one has the highest spreads, again, due to the risk that these type of deals have. One can then check also how different countries compare spread-wise, if it's US, if it's UK, if it's Germany, if it's France, etc. So just providing very granular view on how the market compares in that regard, based on the regions, and then also some new features in terms of the sponsorship. So here one can see a typical spreads on the sponsored deals versus the non-sponsored ones, and again, just see the premia that exists for the non-sponsored deals, which is not surprising. Within the new issuance, also the feature that has been introduced is the market map. And for the market map, what it does is that it summarizes all the available benchmarks across several dimensions. So one can see here that for the US benchmarks, one has the overall characteristics, but then also characteristics per given sector, per size, and then also for the non-first lien. Same is available for the European credit and then also for the global credit. For each of these, one has the main pricing terms and also the latest yields and spreads. One has the credit metrics and one has also the benchmark characteristics. So just to give an indication of how many deals and what the sample size is for each of these segments. Again, very importantly, just to repeat, all of this can be readily exported into Excel, and you will then have a table characterizing the overall market, which can be then very easily used to provide or to produce various outputs, if it's calculations, charts, so anything that can be then used for further analysis or for presentations. Here, maybe to move into the outstanding issues monitor, and maybe to also hand over to Ajay, and just to maybe give some background. So we, as indicated, we're receiving various questions on how we can also track risk better within the benchmark platform, and for that reason, several metrics have been introduced. But maybe Ajay here, if you want to give further insights.
Yeah, thank you, Jovan. I'm Ajay Bandaram. I'm the product manager here at Kroll and for the benchmark team. What we're showing you here is the other tooling, which is for the outstanding loans within our database. Now, we observe, the new issues tooling. What we're showing you is all the new originations that are coming to the market within the last year. But our database also consists of over 3,000 loans which are outstanding. And what we do for these loans is on a regular basis, we are valuing the loans both on our side and also on the StepStone side. We're combining all of the information for all of these loans, and we're creating a similar kind of report that we show for the new originations. So what you're seeing here initially is just a very extended timeline of a deep history of all the outstanding loans that are out there. What's more interesting, I think, over the time is a lot of our clients have been asking us, okay, great, you got this new interface, you had new analysis. What can you show us for around defaults and risk? So what we did was we thought about it. There's really no standard way of defining defaults in the marketplace. Different clients do it differently. So what we decided to do was to take the data of the valuations or the fair value prices, and then group or at least show the percentages of any given benchmark that is below 90. So Johan, if you want to pick the indicators, the risk indicators, price below 90, and select that, this will give you a good idea as to what percentage of a given benchmark is falling below that line. You can also look at any benchmarks. So the benchmarks are already sliced between region, lien, sector, and the sizes. So you can get down pretty far down and find the section of the market that you're exposed to or you're interested in, and then look at the distress or at least the value of the loans that are going below 90. The other two indicators that we're also looking at are the interest coverage and EBITDA. Now, both these pieces of information are reported to us on a quarterly basis when the companies file the quarterly financials. So these are real data being reported up through either our valuation services or through StepStone. And on a quarterly basis, we go through and value pretty much our entire database. And the valuations are coming in. For some clients, we're doing daily valuations, for some weekly, monthly, and quarterly. So they're coming in throughout different times of the quarter. And we just keep updating these metrics as we roll the database forward using these financial metrics. So these are the new indicators that we just launched. We do have a plan to start getting into other types of information that we're also tracking down the line. And I'll briefly give you an overview of what's coming in terms of our roadmap over the next quarter or so. So Jovan, if you want to just switch over to maybe the deck, then I'll just highlight the upcoming enhancements. Great. So the new enhancements that are upcoming of three types of categories. One is just the interactability and the usability of the tooling. One is around how we can enhance the market structure report that you just saw, where you can break down and go figure out what the details of each benchmark are, and then introducing new indicators. On the chart and table and the UI, you're able to zoom in and look at specific time frame. However, it's like a lot of our clients wanted to start and end at quarters or at specific years. So we're going to introduce start and end dates. We're going to increase the number of indicators that you can compare from 2 to 3. I think beyond 3, it might get a little noisy, so we kind of capped it at 3. We're going to introduce a lot more percentiles for different indicators. And then finally, on the UI, we're thinking about adding stickiness to the view. So every time you log back in, you'll look at the same combination of inputs and benchmarks that you've selected. On the market structure report, we plan to give more transparency and add a lot more breakdowns of how you can look at a trend in the market. So giving more transparency on the graphs, like number of deals that are constituting into a specific bar, or stacking the distribution of, let's say, the overall yield, or breaking it down by base rate, spread, and OID. We're going to add a lot more histogram buckets, because that's been a very, very popular request where clients wanted to see range buckets of leverages, let's say, like 0 to 5 or 5 to 10, or even for shorter buckets. So we're going to have a bunch of those indicators broken down by range buckets. And then lastly, the number of indicators that we're considering right now are especially around risk, our LTV and PIC indicators, and then around financials. We got a lot of requests for the multiples, leverages, revenue, and EBITDA growth. So all of this stuff is in our roadmap, and we're working on prioritizing it right now. So expect to see new enhancements and new data coming through our platform over the next couple of quarters. So this is around the platform and the tooling, but taking a step back, we have some plans for newer tools that we want to introduce here in the marketplace. So I will turn the webinar over to Lee Cardy, who will now talk about a couple of new exciting tools that we're planning. Thank you.
Thank you, Ajay. My name is Lee Cardy. I'm in the private capital markets group here at Kroll, and I work with Ajay and Jovan, focused primarily on these benchmarks that we're talking for you now. And what I wanted to do is just take a couple of minutes to walk you through our next steps and what's in the pipeline here. One of the really great things about our launch, and David mentioned this right at the outset, excuse me, is that getting out to see so many people, we've garnered a tremendous amount of feedback about the product that we have and the product that you would like to see. And all of us have an extensive background in financial data and software and analytics, and we're very much of the mindset of taking that feedback, categorizing it, prioritizing it, and using that to really steer the development of this effort so that we can come up with something that is as useful as possible. This entire presentation is in some ways our first very concrete effort to address just a tiny portion of that pipeline or that feedback. There's really been just so much of it. And it's come through in the form of new capabilities on the website supporting our benchmarks and new fields and indicators in our benchmark. But there is a lot more back there, and I'm not going to take the time to go through all of that right now, but I did want to walk you through these couple of items. So what I have up on the slide right now is our private credit market report. Jovan referenced this earlier. What this is really an attempt to deliver summary information about how our benchmarks are characterizing the market to your inbox in a light touch way, i.e. not requiring you to come ask for it. This is a push, not requiring a login, and on a regular basis. So this is a distillation of very summary top-level trends that we're seeing, and it comes in the form of 3 separate pages, and I've got pictures of those 3 pages on this particular slide. The first page is really based on data from the primary market, describing trends in new originations that you can go get and access in much greater detail and interact with on the new issue monitor, but that we can summarize for you in a very simple email delivered file. The second page there is really focused on the outstanding issues monitor, which is also something that you've just seen the updates for. And then the third page is really focused on a set of pricing analytics that we have. That is not only what is the price of new issues coming into the market, but what's driving that price. How does that price relate to obligor characteristics, such as the leverage of the obligor, the sector of the obligor, the region of the obligor, the size of the obligor, and how does it relate to characteristics of the loan itself? For example, what is the priority of the loan? What is the term of the loan, for example? And all of this we are summarizing on a monthly basis and planning to deliver it to you. You can access this. We need your email. We're happy to put you on the list if you would like. You can go to the website that we have here on the slide. You can use the QR code at the back of this, or you can just send us your email and we will set you up to receive this on an ongoing basis. The second item that I want to talk to you about is in the pipeline. And this really relates to a tremendous amount of feedback that we've gotten that has taken the form of a great deal of requests for a great deal more information about finer details on the loans underlying the loans in our benchmark database. We have much of that information. We haven't included it originally in our benchmarks, as our real goal there was to provide broad market averages that can be used to describe trends in the market overall. And what we realized as we were getting this feedback was that really we were talking with people who were primarily interested in understanding how loans that are similar to a particular loan, perhaps a loan under consideration for origination, were being priced in the primary market. And so we're calling this new issue comps. And what I have for you on this screen is these are screenshots of actual software, but the software is still under development. And to walk you through the idea here very carefully, at the top, what you have is a pricing summary. And each row of this little report has to do with, for example, what is the price, the spread, or the pricing terms, or the OID on a given instrument. And then there are 3 columns. And the first one is a target loan. That is the loan that you're hoping to get some insight into pricing on. The second is a comp set. That is a small set of loans that are highly tailored to be similar to that loan. And then the third column is a difference column. What are the actual differences that you see? And the idea is that report updates as the 2 tabs that are highlighted beneath it are adjusted by the user. Those 2 tabs have the same structure, roughly the same structure as that pricing summary, That is, there's a target loan, there's a comp set column, and there's a difference column. But there's an additional column to the right, which allows the user to be able to specify a set of criteria to be able to tailor the set of loans to, as closely as possible, replicate the characteristics of the target loan. So there are two tabs there because the first one is focused on obligor level characteristics. And you can see in there, for example, that the target loan is a US loan and the comp set is comprised of US loans. And so the difference there is small, and the criteria there has allowed for US loans, but there are two other domiciles that are added in there. I prepared this, so I know that I put Canada and Bermuda in there. But that's the point, is that I can control the filter on the set, and I can work this down into a very small set of comps that are very tightly correlated with the target loan that I want to price. The second tab in the background is exactly analogous, but it's focused on obligation level characteristics. So, for example, what is what is the amount of the loan? What is the term of the loan, for example? What kind of pricing floors do you want to put in there? What kind of interest rate terms do you want to put in there? And the idea here is, because this is associated with pricing, that the data set underneath this is going to get much broader. That is, we'll be incorporating information that will allow for this sort of comparison that is drawn from the covenant set, the package of covenants that are supporting the loan. It'll draw from the call protection features of the loan. It'll draw from the amortization schedule of the loan. All of this with a goal towards helping a user be able to refine a comp set. I'll also mention there's one third thing here, and it is a set of adjustments or criteria. It's not shown up as a third panel here. It shows up at the bottom of the pricing table, which is a market timing adjustment. And I point that out because obviously if you're thinking about a loan prospectively and you're looking at comps that have already been originated in the market, there could be some timing difference between the date on which those comps were priced and the date on which this other loan may be priced. And that difference is something that we're uniquely suited to help you adjust for because of the origination data that we have in the new issue monitor. That is, we can identify what the average market price of credit risk here in this particular market is, and we can control the results of the comp set for that change in market pricing. All of this is under development at this point, and we'd be happy to talk with you more about this. It is in a beta state, but there's quite a bit to talk about. It's quite a detailed project, and I wanted to just raise that for you right now. With that said, I want to hand the control over to my colleague David Larson from our Portfolio Evaluation Group. That's what we have in terms of prepared materials. We were planning on starting a QA session that David would lead. Thank you very much.
So thank you very much, Lee. And I'm David Larson, the Managing Director in Kroll's Portfolio Evaluation or Alternative Asset Advisory practice. There's been several questions that have popped in from the audience. Let me just kind of start down the list. One of the questions as we looked at the data earlier and kind of looked at let's say the raw information, and Lee, I think as you just talked about here with some of this additional data, how much of what we will be, either are providing or will provide, and I'll paraphrase to say, is qualitative versus quantitative. Seems like that we got a lot of facts there, but really the question is, do we use those facts to give an interpretation as to why spreads are widening or why they're contracting or why something's happening in a certain geography?
Thanks, David. Happy to answer that. At this stage, to the greatest extent possible, everything that we have done has really been data-driven. And the product philosophy there is really, we want to first faithfully describe what we're seeing in in the market. And so our efforts have been focused on making sure that the data are accurate and that they're telling as clear a story as we possibly can. Now, whenever you dig into any data and analytics, there are opinions and there are, there's judgment that's involved. And especially in the last section that I just mentioned, when you start to talk about pricing analytics, there are judgment calls that are made. I'm not sure that that's exactly what your question was. I had the impression that your question was really, are we going beyond presenting the facts and starting to talk about why spreads may be tightening or why spreads may be widening? We have done some of that in the course of partner-specific presentations. For example, on the Kroll side, in our quarterly valuation client call, we have talked a little bit about why spreads may be widening or tightening. But that isn't a part of the benchmarks per se at this particular stage. I do think there's quite a bit of value in that. There's no prohibition on it, but to date, we've really focused on trying to get our description of the market correct.
Let me flip the question around a little bit, because I think we've seen this and quite a bit. There's been a good deal written in the press, let's say, questioning where the private credit market in particular is going. There's been questions about, or there's been a lot of news about certain issuers that may be troubled. Is the data, does it really allow someone to make an informed or take an informed view on what's really happening, as opposed to speculating that, because XYZ credit is in default, that the entire market must be troubled?
Yeah, well, absolutely. It can support that kind of analysis, David. And so you're right. You choose a great example where there have been a couple of bankruptcies that have happened. And in some cases, there's been speculation that this is more of a systemic surge in bankruptcies as opposed to an idiosyncratic bankruptcy of the sort that you would expect in a market that might have an average 3.5% or 4% default rate per year. Now, what you can do is look at our data, and you can take a look at the most recent values that we have for median credit metrics like leverage or like interest coverage or like firm profitability, to see if any of those are showing a systematic improvement or deterioration in credit quality. And you can use that to color your judgment about whether these bankruptcies that we've been reading about are in fact the tip of an iceberg, or whether they are just idiosyncratic events. That's absolutely the case, and that's the intended use.
Got it. You touched on
maybe
defaults.
Just here to add,
Go
if
ahead,
you don't mind.
yes.
Yeah. No, just I think that also is a very valid question with respect to these new risk metrics that were introduced, because that was one of the reasons. So also not to focus just on the median values of leverage, EBITDA margin, etc., but also then to provide an indication on more the underperforming part. And for this reason, there are now this percentage of the universe that is valued below 90, that has negative EBITDA, that has interest coverage below 1, and just to have really a consistent view with respect to the riskiness of the underlying loans. And just going forward, basically, this will be readily available, and it is readily available again across US, across European benchmarks for different sectors, for different company sizes. So also in that way, one would be able to keep track of how risk is developing across all the relevant market segments.
I think that's very helpful, Jovan. And maybe, Jay, I want to come maybe to you. Both Jovan and Lee talked or touched on the potential for defaults. One of the questions that came in is, does the benchmarks, does the data provide information on defaults? Why or why not?
Yeah, so we did think about this quite a bit. there's no standard out there of how do you define a default. There's multiple indicators of what could potentially be a default, but the different segments of the market define it differently. So what the approach we took is just look at the data and then present the data so that you can make your own inferences on the defaults. So the data that we've already released is the price below 90, because we're valuing all the loans throughout the quarter, so we know where the fair value prices are landing. That's one indication. And then the other two indicators that we put out are the interest coverage below 1, and then EBITDA below 0. And that's a real observed data point that the companies are filing, and then it makes it into the benchmarks. Additionally, we are going to start putting out data around which loans, what percentage of the loans are picking, what's the LTV, net leverages, and some revenue and growth rates, down the line. So those are all coming. So a combination of those can give you a pretty good idea of which segment of the market is, having a little more distress than the others.
Got it. A couple of maybe more technical or questions that facilitate the use of the data. One of the questions that came in was dealing with the number of observations. How easy is it to see the number of observations, especially when filters are applied?
Yeah, we're just about to, in our next release, give a deeper look into particularly the market structure report, where you have all of the histograms and the bar graphs. So we're going to add the number of observations. I mean, you can hover over each one now and see the number of observations. It's just not clear right away. So we're adding some more transparency where you will be able to see that data as well.
But it is available today by hovering. It's just we're going to make it more clear.
Yeah, that's right. If you, let's say, pick deal count as the indicator, and then you can see the number of deal counts that are going into each histogram. But yeah, we are going to add that as a standard for all of the indicators, where you can look at the data that's going into it.
Got it. A couple other questions came in. I think we touched on this along the way. Yes, data can be exported to Excel. Yes, the deck that we've shared will be shared after the webcast within a few days. So those will be coming out. Let me double check. If we think about the kind of the overall data, and do you think that the amount of data in the US, Europe, maybe Asia, kind of as the database sits today, how do you kind of look at that? Is that data fully representative? Is there a lot more in one sector than the other? Should we care about that we maybe have less data from certain areas? Kind of, if you could maybe expand a little bit on where the data, the preponderance of data sits, and to what extent it hits with some of the newer sources of data, such as evergreen funds versus closed-end funds. And we already highlighted, I think, Jovan, you highlighted at the beginning that this data is not from scrubbing BDCs. This is much more, let's say, direct to the source data.
Yes, yeah. So 100% correct. So we are not using the BDCs, for example, just to source the data. So the data, as indicated in the beginning, is sourced mainly through two channels. So the first one is the valuation business of Kroll, and the second one is the investment business of StepStone. For this reason, just very sizable part of the market is being captured, because as StepStone, we do invest across various GPs. We are active in the secondary market. We are active in the co-investments. So just it's a very representative set that we are seeing and in which we are invested in. And on the Kroll side, again, there is no bias when it comes to the loans that are being valued. And so also what proved to be very valuable just in merging the database is that we were not observing any material overweights to any particular market segment or sector. So just lower mid, upper mid market loans are very well represented. Very importantly, also our, based on the deal count at least, just we don't have any high exposure also in the database to large corporates. So the database is really the database on middle market loans. So it's not containing syndicated loans or high yield bonds in any material way. And for this reason, given that it covers basically the middle market, that it covers both US and Europe, we do think it's highly representative and that it does not contain any biases in the sample itself.
Got it.
Just to add one more comment to that, we believe that we cover about 50% of the market based on some of the research reports, that indicate that the market is anywhere between 1.5 to, a little over $2 trillion. And the total AUM that, that we're covering across all of these outstanding loans is about $1 trillion. So approximately that's the size that we think we cover.
Another question, maybe a little bit narrow, but do we anticipate being able to look at metrics for split lien loans, or how do we deal with split lien loans?
David, do you want me to take that?
Sure.
Yeah. So the question specifically says, do you have sufficient data? We do have data on split lien loans. Absolutely. The question focuses on whether it's sufficient. And for purposes of creating a specific benchmark or broad market benchmark like what we have, I don't believe it is sufficient at this point in time. We generally like to have, north of 75 to 100 loans to be able to create a credible average for those benchmarks, although we'll allow you to slice it much more finely, not down to the individual loan for confidentiality purposes. But given the size of the market and the number of split lien loans that I see out there, I don't think that we would hit that stage. It's something that we can look into, but we haven't yet. And my expectation is that we wouldn't be able to create a dedicated benchmark for that.
So let me ask, maybe both. I'll ask myself from a Kroll perspective, but Jovan from a StepStone perspective. To what extent are we using the data? I'll say in kind of our own day-to-day work and our reporting on our various platforms. Jovan, maybe I'd let you go first, and from a StepStone, and I'll touch on Kroll.
Yes, so we use it daily. It is part of any client and portfolio update that we have. So just if one wants to indicate where the deals are being originated, so let's say that we have a new portfolio which is being ramped up. One of the things that investors are, of course, asking is where the spreads are, what are the typical underwriting terms. So it's part of all the client-related updates. The data is extremely useful, and just especially the part which Lee was indicated to, so on the new issues comps, also for our co-investment business. So just the ability to compare the deal. So just if you have a particular co-investment and then you see what the spread is, where the leverage is, where the LTV is, in which industry the company operates, you can then check what are the main characteristics of those market segments. And then you can see if, for example, the deal is too risky, if it's maybe attractively priced. So just it adds a lot of value when it comes to also assessing the relative attractiveness of a particular deal. And in addition to this, also then just putting any kind of a portfolio proposal in the context of broader market environment. So just seeing, for example, the spreads and the terms that we have on our side, and then comparing it also to where the spreads are on the syndicated loans, on the high yield bond market. So across the sub-investment grade market is very valuable, because one of the questions that investors typically do have is it now attractive to invest in direct lending? And all of these questions can be then addressed through the benchmarks.
I think, and from a Kroll perspective, we're incorporating or planning to incorporate the data as appropriate in our quarterly reporting, and we are we took a little bit of time to make sure everything was working as we expected. So we've been using the data in our daily, monthly, quarterly evaluations as a corroboration of what we were seeing. I think we'll be introducing it very rapidly as a primary data source in valuing individual credits on a periodic basis for our clients. We're getting close to time. I think that as a question about how far back does the data go, more than 10 years, I think close to 15. Obviously, some of the older data is maybe a little bit spotty, but definitely back a good 10 to 15 years. I think I hit most of the questions that have come in. To the extent we haven't hit them, or if you have additional questions, please reach out to any of us, and we'll answer those questions directly.